We're seeing a market shift in the summer of 2024. What does this mean for real estate? And are we headed to a market crash? Hey, I'm James Peddie with the Moving to LA channel. Thanks for jumping on with us. Be sure to like, subscribe, and follow along. And thanks for joining us for this market update. We were cruising along in the spring of 2024 and just seeing things go absolutely bonkers here in the San Gabriel Valley where I live. In Altadena, Pasadena, I was putting offers in on homes with clients and just not getting anything accepted. We were getting multiple offers. Things were going absolutely crazy. And then come the end of June, sort of got quiet, and I thought, what is going on? And so today we just want to review what's happening in the market. The first thing we're going to do is take a look at this infographic for the July sales report on real estate from the California Association of Realtors. Okay, so here is what the report is saying. Existing single-family home sales totaled 270,200 in June, and we're seeing that's down 2.7% from June of 2023, which was 277,690. June's statewide median home sale price was $900,720. That's down 0.8% from May and up 7.5% from $837,850 in June of 2023. Now that growth rate is a little higher than what we had anticipated. I was telling people in June of 2023, we should expect a growth rate of 3 to 5% over the next year. So that did exceed my expectations. However, the year-to-date statewide home sales edged down 0.5%, which means, kind of break that down, 36% more homes are available in June of 2024 than were available in June of 2023. We currently have 4 months of inventory on the market, and homes are staying on the market for an average of 18 days, which is still huge, but it isn't the 10 to 12 days that we were seeing. That being said, home sale prices on homes that are $2 million and above, we're seeing an increase in those sales. So we're seeing multiple offers on those homes if it's priced right, but homes under the $2 million mark, we're seeing those homes level out in terms of pricing and are not getting as much activity. Okay, so the natural question is, what the heck is going on? Because even though 2008 was so long ago, it is still in people's minds. The fear of the Great Recession still lingers in a lot of people's brains regarding real estate, and it should, because it was a huge lesson learned. But what is happening in the market? Well, so what is happening? Number one, the Fed made the announcement that we shouldn't expect rates to come down this year at all. Okay, and so for many people at a 7% interest rate or more, that means it's less expensive to rent than it is to buy. So it's more economical to continue to rent than it is to buy a home. Secondly, when we see record prices like we saw in the spring, we see a lot of homes coming to market, homes that are not like fully renovated, kind of that top tier home product. When those come to market and those start selling gangbusters way over, it encourages a lot of other sellers to think, well, this is my time to enter the market. And so we see a lot of people who put their homes on the market and overprice them because their neighbors are getting such great deals and the homes may not be that awesome and excellent. And so we do see homes that are overpriced hitting the market. And when that happens, homes are overpriced. It doesn't matter how hot the market is, it's still going to sit longer and take longer to sell. I believe this could be an issue of seasonality. People go on vacation. We often have a summer slowdown. After the 4th of July, things typically slow down, and then people go on vacation, and then come beginning of August, or even that after that first week of August, people start coming back and are thinking about school, and we see the summer momentum pick back up at that time. So as a realtor, I get two main questions. People ask me all the time, is it a buyer's or is it a seller's market? Well, I would always tell them it is based on your perspective. Typically in California, if you're a seller, it is a good time to sell. I mean, it really doesn't matter. It is a great market. You're going to get a great price for your home. It's going to exceed most everywhere else in the United States as far as your return on investment if you've purchased, 5+ years or more ago. So in that sense, it's always kind of a seller's market, but we are seeing, due to the slowdown, that when we see a market slowdown, it is an opportunity for buyers. So I'm out there texting, calling, reaching out to all my buyers saying, hey, if you want to deal with less competition, now is the time to enter the market. If you are thinking, hey, I can at least get in and then have a little high interest rate for a bit and refinance later, now's the time to do it. So I'm telling you, hey, this is the time. Strike while the iron's hot. It won't last forever. And the reason I'm saying this is because when interest rates come down, or when they show a hint of coming down, there are ample amount of buyers ready to enter the market, because buyers function on a cycle of typically 60 to 90 days. So what that means is that when buyers are ready to enter and purchase a home, they're going to go to their lender, they're going to get approved, and then they're going to get out there and start making offers. Now, we've seen high interest rates over the past couple years, okay? And a lot of buyers who were ready to enter the market decided, hey, let's pump the brakes on that, let's hang back. And then when the market kind of cools off and rates come down, we'll enter the market. Well, now we have a backlog of buyers. And I'm telling you, there are so many buyers out there ready to jump in when the rates come down. And I'm thinking it's going to be an absolute bloodbath out there. So that's why I'm telling all of my buyers, get in now, because now is an opportunity to get something at a good price, because you can get in at a good price and refinance later. But the price, when it goes up, you have no control or power over that. Okay. And then you're going to be competing against everybody. So it's a good time to get in if you can do it now. And the second question I typically get from my clients is, are we headed to a market crash? And though we are seeing a bit of a market slowdown in the summertime due to interest rates, due to just the seasonality of things, I would say that we're unlikely to head to a crash. But anything's possible. We could have that volcano erupt, that tsunami happen, that earthquake. During the Northridge earthquake back in the 90s, I think 94, don't come at me, I think it is 94, could be wrong, which my wife was in. I mean, her chimney literally fell off her house there in Chatsworth. That suppressed the real estate market in that area for 18 months. So we saw a lot of people exiting California. So natural disasters can happen. We have no power over that. They can suppress the market. But the good news is, it doesn't keep people away forever, okay? Like, the market will bounce back. But in order to have a market crash, we would need to see a lot more inventory hitting the market and not selling, okay? So in the past, we've had 2 to 3 months of inventory on the market, and that's why competition's been so steep, because there's so many buyers and there's such little inventory. Now we are seeing homes stay on the market a little longer, and so we now have 4 months of inventory. Okay, so we have 4 months of inventory available out there. Now, in a healthy market, we have 6 months of inventory. This just means when we have 6 months, things are very level. They don't spike and go crazy on price. It's just a healthy, growing market. During a crash, we're going to have something like 8 to 9 months worth of inventory. And that just means there's too much inventory for the amount of buyers. And when there's too much inventory, there's not enough demand for the homes, which makes the home price drop. And so we're only at 4 months of inventory. So that explains, why things are not going absolutely bonkers right now. But if we do see a glut of homes hit the market, we could see that. I will say this, that I am seeing in Pasadena and Altadena a lot of notice of defaults and bankruptcies. Now, I've been tracking down these homes. I've been looking at who are the owners of these properties, and it seems to be people who are elderly. All right. And my assumption is, and don't quote me on this, but what I think is happening is that during the pandemic, some of these homeowners either borrowed against their property for a HELOC, or they took a loan out against their property in some way that had a 5-year arm or a 5-year period. And then that has expired. Okay. And the interest rate went up. So that could be a reason that people just can't keep up with the new payment after the 5-year balloon. And combined with the fact that our insurance rates are going up in the area due to State Farm and others pulling out of Altadena, Pasadena, and not insuring people for fire. And then the companies that are here are now charging double and triple what people were paying before. So I think some people could just be caught in a really bad situation where their HELOC 5-year term is up and they're getting hit with insurance premiums that are too high, and that is causing them to not be able to make their mortgage payment. And we are seeing notice of defaults and bankruptcies based on that, would be my analysis of why that's happening. So because I get so many questions about a market crash and what happens and how will California survive, when is that going to happen, let's go ahead and look at the worst crash that happened in 2008. The worst crash since 1929. Let's look at the data. We're going to analyze Pasadena, and we're going to see how the market crash impacted numbers and how long it took for those numbers to recover, okay? So, what you're going to see in the data I'm about to show you is that Pasadena had a 20% correction in 2008, leading up until I believe 2014. The lowest of the low was 20%, but it didn't stay there for very long. I would say that we only saw that 20% correction for about 9 months, and then things began to shift. Compare that, say, to Ohio, which saw a 40% correction in places like Cleveland and Columbus. So, all that to say that Pasadena and California real estate is rather insulated due to the demand. We're always going to have people wanting more sunshine, wanting to live here. And because there's demand, it keeps us insulated from major price corrections. So let's look at the numbers before the crash happened. In 2007, the average price of a home in Pasadena was $982,000, which was about $495 a square foot. Then the next year, as the recession set in, we saw a year-over-year correction of 14%. And at the same time the next year, in 2008, home prices were $845,000, or an average selling price per square foot of $422. Then kick over to 2011, where you kind of hung around at that 14% correction rate. In 2011, we saw it dip to 17%, and that is $818,000 for an average home in Pasadena. And then in 2012, we saw the deepest part of the correction, and home prices dropped to $792,000. That was the time to buy, guys. That was your moment to step in. I mean, can you imagine that? An average home, 2,000 square foot home for $792,000 in Pasadena. Then in 2013, we pulled out of the correction zone. So we went from 20% to a 7% correction off that 2007 price point. And the average selling price of a home in Pasadena was $915,000. And then after that, in 2014, we saw prices exceed the 2007 rate, and home prices were $1,042,000 in Pasadena. So going from 2008 to really 2013, 5 years, if you're willing to hang on for that amount of time, you saw your investment in your home dip and then pull out. And then since then, it has gone absolutely skyrocketing up and to the right since then. If you were to look at that price point from 2007 to today, we are looking at a 102% increase in price, meaning your home price has doubled and then some from the highs of 2007. So the average selling price for a home in Pasadena is now about $2 million compared to that in 2007 price being $982,000. I really wanted to look at those numbers because I want you to have an understanding, because there's a lot of fear of the next crash. And listen, like any investment, like the stock market, things can have times where they go down, where your investment loses value, but it won't lose value forever because, like I said, California is an insulated area. Everyone wants to live here. We've got the ocean. It's an amazing location. It will continue to be a great location, and people will always want to live here. And so that is an insulated understanding of your investment, knowing that you can have your home here, knowing that it's always going to have value and will continue to increase in value over time. Thanks for sticking with me on this market update. I just want to reiterate that even if we did see a massive market crash, people will always want to live in California. It's always going to be sunny and beautiful here. The ocean's not going anywhere. So we will continue to have a great location. This is always a great place to invest, no matter what time you jump in. If you plan on holding your home for 5 years or more, it's going to be a good investment. Guys, if you'd like to check our inventory, go ahead and check out our upcoming inventory or off-market deals at jamesfromla.com, or feel free to reach out to me at 626-375-1731. If you want to jump on a call or let me know that you'd like a consultation, all we're going to do is schedule a quick appointment. And then on that call, we're going to go over your criteria of what you're looking for and then help craft the best strategy to find the home that's perfect for you. Guys, thanks for sticking with me. Have a good one. Catch you next time.